As the market falls for yet another day after that pretty much abysmal CPI report, we kind of have to go over the question of, is it time to start taking money off of the table and waiting for the market to bottom? Now, there's a couple of things wrong with that statement right there, but in this video, we're going to be going over exactly kind of what we need to look for and the strategy that you guys should be keeping in mind when we're going into these next couple of months where we are going to be seeing a lot of market volatility. There was some very interesting pieces of news that actually came out today that I want to go over with you guys, and some very interesting things that we are seeing on the chart. So again, guys, before we get into all of that information, if you do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. And again, 1348 gang, let me know down below what your favorite play of the day was today. I know you guys crushed it. So let me know down below in the comments what your favorite play of the day was. Now, getting over to the chart right here of the SPY, the S&P 500 right here, the ETF. We are seeing the SPY at a very, very key level. Now, that 390 level that we've been talking about a lot has currently, at the time that I'm recording this, slipped. Now, with what's happened this week, the CPI data coming in higher than everybody expected, we have what we're going to look at a little bit later with the probability that we're going to be getting a 100 basis point rate hike. There's a lot of fear in the market right now, especially going into these winter months. So technically on the SPY here, we do have this daily cross down on this daily time frame with 1348, the most profitable EMA crossover. We have the MACD building momentum, RSI back down below its moving average as well. So going into the Fed next week, we are going to see a lot of volatility. We're going to see the market fly around. And again, knowing how to take advantage of these moves is going to benefit you guys in the long run. And I do want to shout out a couple of people in our group here. The AR guy, 9.29% on the day here. Our members are absolutely crushing it. So again, guys, if you want access to all of the live streams, curriculum videos, algorithms, make sure you guys check out that link down below and come see why we like to say we're the best place to come and learn how to trade. So getting into some of the data today, and then at the end, we're kind of going to be going over some of the strategy and why everybody likes to say when the market is coming down that, okay, maybe we should be selling and repositioning here. Well, right now we are seeing the Fed, the Atlanta Fed, the GDP Now estimate has been slashed again. So the Atlanta Fed's GDP Now model estimate for real GDP growth at the seasonally adjusted annual rate in the third quarter of 2022 is just 0.5% now, down 1.4% on September 7th, and down from 2.6% on September 1st. Remember, first quarter, declining GDP. Second quarter, declining GDP. Textbook definition of a recession, but all of our policymakers like to say that it's not, and inflation is under control, and we're gonna be fine. But again, it seems like a lot of these basically policymakers have lost a lot of control over what's going on in not only our markets, but our global economy as well. Now, again, coming over here, this is where we are seeing this estimate from. So the latest estimate on GDP from GDP Now, the Atlanta Fed right here, 0.5%. And the next time that this is going to be coming out is Tuesday, September 20th. So make sure you guys have this event marked on your calendars here too. This is one of the reasons why we are seeing the market having such a red day today. Now, when we're actually going to be getting this GDP data over here is going to be October 27th. That's going to be the preliminary advanced estimate, and that is going to be the first time that we're going to be seeing what the GDP numbers actually are. Now, due to all of this happening, we are seeing the continued fear of higher rate hikes coming in the near future from the Fed. We have that Fed meeting next week, and now we have an 80% probability of a 75 basis point rate hike and a 20% probability of a 100 basis point rate hike. With the inflation data that has just come out, and the track that energy looks like it's going to be going on getting into these winter months with the situation with Russia and Ukraine, energy prices most likely are going to continue to go up. We have very, very low oil reserves right now, relatively in the United States. So we're going to need to restock those. And when you look at those oil reserves from the SPR right here, we see a very significant decrease. Now, what this can also be read as is that the United States is releasing more oil and energy into the market to try to provide more supply to to decrease gas prices in order to try and stifle a lot of these inflationary pressures here. So we're not really seeing that effect on inflation or really any other metric here where oil and gas have come down, but we didn't really see that reflected back in a lot of this inflation data here. So what this leads to, well, the Fed needs to come out and increase interest rates more in order to stifle the inflationary pressures on our market. But remember, what does that do to asset prices? It significantly decreases them because when the Fed raises rates, the discount rates that are used in the discounted cash flow models to value a lot of these companies presently, the discount rates go up, meaning that the present values of these companies are going to be going down. And that's where it leads us into this situation of, well, is it time to sell everything? And now that's kind of an interesting statement there because, again, you guys have heard these statements a lot in the past where you think about long-term investing a very different way from trading, where time in the market is going to be timing the market. But there was a very specific time in which you guys could have timed the market. When you go back to the SPY on the daily time frame here, as soon as Jerome Powell released the words from his mouth, rate hikes and quantitative tightening back in late November over here, well, that would have been a good time to start trimming positions in the market. And looking where we are at right now from these highs, let's see, right around here was where we were seeing basically all of our policymakers start to talk about tightening and rate hikes right around 473, reaching those highs around 480. Well, we're currently sitting at 389. So if there was a time to start liquidating everything backward looking again, well, it was way back here at the end of 2021. So right now, in my opinion, it would make more sense to hedge positions, take these short-term bets and learn how to make money in this market right now, or just continue to buy the companies that you think you are going to outperform or think that are going to outperform over the long term. The companies with good fundamentals, the companies that you use every single day, that eventually, once we get back to a normal environment, are going to see a decent amount of growth. The other thing that you have to keep in mind is the tax obligation that you would have if you've been in the market for a significant period of time and you are still very green on your portfolio. Long-term capital gains rates over here for a single person who is making up to $40,000 a year, $40,400, 0%, $40,400 all the way up to $445,000, 15%. That's most likely what most of us watching these videos here are going to fall into. And the 20% rate right here is for anything above $445,000 here. So anything that you have gained in the market, any capital gain that you have, well, you're going to get taxed 15% on that. So the market, in order to make selling everything and repositioning actually make sense, would need to fall more than the tax gain or the tax that you would have to pay on those gains that you have had. Now, is it possible that the market falls down lower than that? Yes, absolutely. Let's say you have a $10,000 gain, paying 15% gains on that. Well, that's about 1.5%. Can the market fall 1.5%? Well, if you look at it right here, it's down 1.4% today. So yes, it absolutely could, and you could reposition. But at the end of the day, like we said earlier, time in the market is really going to be timing the market. And if you're thinking long-term about this, dollar cost averaging is usually going to be the best way to go. Can we see a lot more volatility? Absolutely. But there are many, many ways out there that you guys can take advantage of all of these volatile moves. You just have to know where to look. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great evening. See you guys in the next one. Peace.